All right, so you're having that talk, right? You know the talk we're all talking about. The home buying talk. Not that one. The home buying talk. You're thinking, I want to buy a home maybe in the next few years. What do I got to do right now to get in best position for that? Let's talk about that. This doesn't mean you need to know exactly when or even if you want to buy a home, but it is important to take some steps right now to put you in the best position when that time comes. I'm Tony from Wealthfront, and we're going to talk about how you can put yourself in best position today for a home purchase in the future. First off, strongly consider paying down any debt you have outstanding. When you pay down your debt, you decrease your debt to income ratio, and this is a key input in determining the terms and interest rate for your mortgage. Your debt to income ratio is simply all of your outstanding debt in ratio to your pre-tax income. Most lenders calculate this on a monthly basis to get a better understanding of how easily you'll be able to make those monthly payments on your mortgage in combination with all the other debts. Basically, can this person afford the mortgage plus all the other debt they have? A good rule of thumb is that your total monthly debt payments should be less than about 1/3 or 33% of your monthly pre-tax income. So when you apply for the mortgage, the lender looks at all of your debts, we're talking student loans, credit cards, auto loans, etc., and then calculates that ratio as one of the factors when determining your eligibility for a mortgage. If you have a longer time horizon though, don't feel the pressure to pay this off right now. Instead, use this moment as the start to planning yourself, the beginning of even thinking about, hey, maybe in the next few years, here's what I might have to do. So use this moment as the start to the plan to free yourself from all the other debts that by the time you're ready to own a home, you're in a better position. Just think about it. You're debt-free and you own a home, besides the mortgage. Personally, that's what we as a family strove for and achieved, and I can tell you, it was one of the greatest financial goals we have achieved so far. Second, start improving your credit score. Kind of obvious, right? Well, lenders use your credit score to assess the risk that they're going to be taking on when giving you a loan or a mortgage, and then use it to determine when you qualify for the mortgage and what interest rate you'll even pay. A healthy credit score to get the best mortgage terms is typically about 740 or higher, so you should strive for that at a minimum. But how do you improve your credit score? Well, paying down debt is the biggest key. In fact, credit utilization, or basically the balance of your debt in comparison to all of the available credit, contributes almost 1/3 of your credit score. To simplify this, just focus on paying down as much of your debt as possible to get this credit utilization rate as low as possible. It's that simple. Now, if you don't have any debt, but you also don't really have a long credit history, which is actually another factor here, you may want to consider building up your credit history before even considering buying the home. An easy way to do this is utilizing a few different credit cards regularly, paying them off, but using them, paying them off in full each statement, and proving to the credit bureaus that you're a healthy and good borrower. It might sound a bit backwards, but this is actually really important if you're just trying to build some credit in the first place. So let's look at an example of maybe what improving your credit score could actually turn out to be in real numbers. All right, so we have two loans. Let's assume $1 million home, $800,000 mortgage. One mortgage, the rate is 2.75%, so your credit score is much better. The other mortgage, your credit score is lower, let's say under 700 or so, and maybe you're paying 3.5%. The difference between those two is the higher rate, you're spending about $300 more per month. Doesn't sound like a huge deal. I mean, I would like $300 more per month, but does it really mean you should change your behavior right now? Well, look at the entirety of the loan. Assuming a 30-year fixed rate mortgage with no refinancing whatsoever, having that higher rate can cost you over $100,000 in the grand scheme of things. So just simply by working on improving your credit score now, you might get that lower rate and save maybe $100,000 at some point. That sounds pretty real to me. So let's say you have an average credit score and you're kind of early on in your wealth building years, and you're in your early 20s, and you want to get your rate from a good to really excellent score. It might take at least a year. So you gotta start planning ahead and don't assume that it just happens overnight. And if you don't know where to start with this credit score thing, download an online credit monitoring app right now. Honestly, it's completely free. Don't pay for it, completely free. And it helps you just better understand and track your credit score. You might even learn a few things that'll help you set some good habits. Lastly, budget wisely. Okay, that one's a bit vague, right? Great, here we go. Another millennial or boomer talk about budgeting, right? Well, just think about it in super simplified terms. Either start saving more or just start spending less. Both of these actions will put more money in your pocket in a better position down the road, right? Personally, I like the idea of simply tracking your spending more closely to really understand what you're spending your money on. There are a ton of apps that can aggregate all of your credit card and debit card expenses and that allow you to easily track these. I do this every day, and it helps you become a little more aware of what you're spending, and it curbs that bad behavior. Trust me, when you see those large expenses a few weeks later, you kind of question yourself, did I really need that? You end up thinking about that the next time you might go for a large purchase. So in all, some people like the idea of either increasing savings or just find it easier to spend less. I mean, you choose what is best for you. Either way, by defining a monthly amount to put towards that home in the future and then appropriating that savings or investment account, your future won't become an afterthought. Just don't complicate this one. Put your future home in your current planning now. All right, thanks again. This is Tony from Wealthfront. We'll see you next time.